One of the things that we've found, since I've been at Latham is how synergistic the energy and infrastructure group has been with the emerging company group, and how, we've had deals that we've had to call that group up and talk to them about, types of project finance or other fundings that we don't typically see.
You're right. I mean, you have to take a fully holistic approach, right? So coupling with our industry expertise and our various practice groups, right? So you can solve not just one piece of the puzzle. You can provide solutions for the entire project lifestyle in a commercially feasible manner. Hello, and welcome to the LathamTECH Podcast, where we survey the latest trends emerging from the world of tech and explore their impacts on your company, both the opportunities and the risks. In this episode, we'll be discussing the rapid rise of energy tech, from how the companies in this space differ from traditional venture-backed tech companies to the new power sources competing to fuel the data center boom. So Scott, energy tech is a broad and rapidly evolving space. How would you define energy tech, and how do these companies differ from your traditional VC-backed tech companies?
Well, like you said, energy tech is very broad. It covers a lot of things. It can cover software that's servicing the upstream oil and gas industry or other energy transition technologies, all the way to the technologies themselves, whether it be things like geothermal, solar, or servicing data centers. As far as how it differs from typical venture-backed companies, the software companies maybe not so much, but the hard technology companies, they have a lot of different sources of funding that they can seek, and there's different types of funding for different strategies for these companies. For instance, they might want venture capital to begin with, but down the line, it may be better to seek other types of finance, whether it's government loans and grants. It could be more project finance and private capital that you wouldn't typically see at traditional venture-backed companies. To that end, the AI and data center boom is, as you mentioned earlier, is huge. Like, what are you seeing as far as the technologies that are helping to service the data center and AI boom?
What we're currently seeing is a real shift in how data center developers think about power. Gone are the days where they're exclusively relying on the grid for power, and more relying on themselves to control the power directly. And this is primarily because the grid is not sustainable for the high demand, largely driven by AI. You have transmission and interconnection constraints that are causing significant delays in putting projects online and causing power reliability concerns for data centers. From a technology perspective, we're seeing a lot of interest in fuel cells because they're deployed relatively quickly at the site. We're doing a lot of deals in that space. We're also seeing a significant resurgence in natural gas. But from a technology perspective, it's the way they're deploying the natural gas, moving from a centralized generation model to individual units on site to deploy the power efficiently and directly to the data center. Renewables and battery storage continues to remain firmly in the power mix, but those are often coupled with other power sources to deliver a continuous power solution. And finally, for the long term, you mentioned geothermal. We're seeing a lot of interest in geothermal, and to a greater extent, nuclear, so long as they can provide sustainable power in a continuous manner because of their firm, carbon-free baseload. And in addition to those technologies, we're also seeing long-duration battery storage and microgrid solutions that are helping fuel the data center boom.
And I think one of the things that's interesting about all these new technologies is that, unlike what we may have seen with traditional oil and gas or energy companies and how they raise money and the entrepreneurs in that field, it looks a lot more like a Silicon Valley style company for a lot of these technologies. And we'll talk about this, but they're running into the headwinds of, well, what type of investor do I need for my company? Are they willing to make a venture style investment?
Yeah, and I think one of the unique points about that is just the revenues. Right. The data center market has become very attractive from a commercial and financing perspective. You have a significant immediate demand coupled with highly creditworthy counterparties that are seeking long-term, customer contracts. Right. And so from a technology company who's not used to this, continuous and consistent revenues, this is, a revelation. And from an investor perspective, because you have the more constant contracted cash flows, you're seeing an influx of infrastructure funds, particularly with fuel cells. You're seeing private equity funds, particularly with geothermal. And then for nuclear and a host of the other technologies, you're seeing a significant demand for the public capital markets. primarily because the cost to fund and develop these site power solutions on site is significant.
Yeah, that's a great point. The data centers have become just sort of the end-all be-all of a lot of what we're doing right now. In fact, we're seeing a lot of technologies and technologists that maybe were in other fields starting to pivot into the data center space. What are your thoughts on that? And maybe give a couple of examples of what you've seen and how that's going.
Yeah, piggybacking off our prior discussion, the revenue generation, revenue certainty from these long-term contracted cash flows, right, is pushing many of these technologies into the space. An example is fuel cells. Fuel cells has historically been an on-site niche power solution for industrial companies. Now it is front of the lines on-site power for data centers. Take to a lesser extent geothermal, which utilizes oil and gas techniques, which has now moved into this industry as well. As a result of these technology companies pivoting to the data center market, coupled with these contracted revenues, as we mentioned, we're seeing significant interest from infrastructure funds, private equity funds, the public markets, as well as family offices. Right? These new investors, have a more conservative profile than your typical tech investor. How is that changing, or how do the terms look different because of that?
Yeah, James, it's interesting because you're right. The venture investors, there's a specific model there. They, it's not an understanding, but they know that some of their investments aren't going to work out, and they're going to write them down to zero, but they're going to have hopefully enough home runs and grand slams that it makes up for the difference. At the end of the day, these are still technology companies with speculative technologies that need money to grow and to advance their technology to get the revenue you're talking about. But these new investors, whether it's infrastructure funds, whether it's private equity dabbling in minority and venture investments, or family offices that are used to investing in upstream oil and gas that are now looking at these technology companies, they've got a much more conservative profile, as you said. They can't have losers in their portfolio. And so as a result, the negotiation, especially if it's early money in a company, becomes pretty difficult sometimes for the entrepreneur who's expecting very simple NVCA, National Venture Capital Association style term sheet from their first investor. And so what we've got to do is, the attorney to the company and sometimes the attorney to the investor is help play Rosetta Stone. Is like, we've got an entrepreneur that expects very light terms, very laissez-faire control or by the investor. And we've got an investor who needs to make sure that this company is going to work. And so we're talking to these entrepreneurs and saying, look, you want the money from these folks that know the industry. You're going to have to take some terms and some provisions that maybe you would not have gotten from a West Coast VC. Similarly, when we have to talk to the investors and we have to say, you're investing in an entrepreneur that is putting their technology on the line. This isn't an upstream oil and gas development that people have done 100 times. They don't want to give up their technology and control of their company on this initial investment. So we've got to come to the middle here and kind of understand what both parties want to get to yes, and to figure out exactly how we are going to, get a deal done. And sometimes the deals don't get done as a result. But the other thing I'll add to that is there's an importance for these energy tech companies to be able to plug into the investors you talk about, because at the end of the day, whether it's a strategic investor, which is another type of investor we didn't talk about, or it's these infrastructure funds that have been in the energy industry for years, they know the supply chain. They're the ones that are going to be able to plug the entrepreneur into the vendors and the customers that they need to create the revenue that's going to be required to get returns for everybody.
Yeah, and I'll piggyback off that. I'll say, particularly as these investments scale, right, and you've got contracted revenues, you're bringing in infrastructure funds, right, who are really only going to invest if you have the contracted revenues there. I think one of the key elements they bring is the relationships with project financing, right, because none of these projects get done with equity alone. They all require project financing, and to have those relationships, the sophistication of how to interface with those financiers is critical.
Yeah, and I think it's important to understand with these energy tech technologies that are, again, more hard science, that are going to require a lot of capital to build the facilities, to build the infrastructure needed to create the revenue. Think geothermal, think, there's a lot of different technologies. Fuel cells, anything that's got to manufacture or develop or produce. It doesn't make sense for venture capital to be the thing that's funding that in the long run. And so the venture capital is there to maybe get you to the pilot and get that pilot project off. But if you're funding I don't know, a $500 million plant with venture capital, that's really diluted to the founders and the early investors. And there's better ways to do that with the private capital we're talking about.
So Scott, as we've discussed the various funding alternatives available, how should companies be thinking of the various alternatives as they grow energy tech?
Yeah, sure. I mean, I think one of the things that's very important from the beginning is, getting the right professionals. And yes, that includes lawyers, but it also includes the right financial advisors, the right technical advisors, and getting them on board quickly and getting the right team in place, because what you're trying to build is very complex. I think from my perspective, I've got two different clients right now that are in this data center space, and simultaneously we're trying to raise venture capital. At the same time, we're trying to prepare for a project finance of their first facility. And that's got to run hand in hand. You can't do them in two separate vacuums. We have two teams working on them for certain, but they've got to work together. You can't raise money here and raise money there and not have it speak to each other, because you've got to make sure that what we're doing at the project is going to be viable for the top, so we can do more projects later on. And I think one of the things that we bring to the table at Latham that is having that expertise both in venture capital as well as the project finance, the commercial agreements, these offtake agreements that a lot of these tech companies need to show that they're going to be able to generate the revenue once the plant or whatever has been built. Doing all of that in parallel is something that is very unique to our firm, I think. And having whether it's the global aspect of it and having offices all over the world, but just the expertise generally. I mean, even in Texas, where we have a very strong emerging company practice to pair with our energy and infrastructure practice, it's something that allows us to fully service our clients across the country.
You're right. I mean, you have to take a fully holistic approach, right? So coupling with our industry expertise and our various practice groups, right? So you can solve not just one piece of the puzzle, but you can provide solutions for the entire project lifecycle in a commercially feasible manner.
Correct. I mean, if you one of the things that we've found working with, since I've been at Latham, is how synergistic the energy and infrastructure group has been with the emerging company group, and how, we've had deals that we've had to call that group up and talk to them about types of project finance or other fundings that we don't typically see. And similarly, a lot of the investors that those groups are working with are doing more venture style funding that, you want to have a strong emerging company group to be involved with, so they can go into the company and negotiate against company counsel in a way that fits that type of transaction. It's really important that you have the right type of lawyers negotiating the right type of transaction, because a lot of different things can go wrong if you don't, both for good and for bad. But it's something that you really want to pay attention to, and that's something we're able to provide.
And Scott, these are all great points, and the need for an integrated platform is because these transactions are highly complex. There's not a single well-defined playbook. We're dealing with transactions at the intersection of infrastructure, energy, technology, all with different regulatory frameworks, capital profiles, risk appetites. So in a single transaction, you can be dealing with evolving energy regulation, a project finance considerations, M&A dynamics, IP concerns, and highly complex bespoke commercial agreements, right? And additionally, all this is happening at real time, right? And so the concerns about risk allocation, bankability, and ensuring you putting together arrangements that can hold up through the entire course of the project require a holistic approach.
That's fair. And I think one of the things that you use the word bespoke and as to the commercial agreements, but I think you can apply that to the entire transactions or set of transactions that each company needs. And I think especially for the people in my world in venture, where things can be a little rote sometimes, we're going to use these docs and we're not going to veer from them. It's sometimes a hard sell, but it's really important for entrepreneurs, I think, to understand that if I've got this new, sometimes first of its kind technology, the transactions that are going to be required for me to commercialize it are very likely going to be also first of its kind in a lot of ways when you combine all the different ways that I'm going to have to raise money. And again, bringing a group of lawyers or a group of experts or a group of professionals together that can see around the corner and figure out how to work the entrepreneur piece of it into the project finance piece of it with the the regulatory piece of it, and know how to bring all that together is just very important given the complexity, James, that you mentioned. So let's look into the future a little bit, James. What technologies do you think are the best positioned to succeed? And similarly, with respect to data centers themselves, where do you see that industry going, and what do you think the most successful technologies are going to be there?
Yeah, so taking a step back, and we mentioned this at the beginning of the podcast, one of the major bottlenecks in the data center market is the availability of power. It's not demand, right? And you couple that with the continuing evolving demand landscape, more power dense chips, right? New advanced cooling technologies. The need for power continues to evolve and increase. So in the short term, it's technologies that can be deployed quickly to deliver reliable power. Natural gas, distributable power solutions, fuel cells, and solar. Over time, you're going to see a transition, not away from those technologies, but also towards more long-term durable technologies that have a low carbon profile, geothermal, and to a greater extent, hopefully, nuclear. In particular, with nuclear, the great interest is around fusion because of its low waste profile coupled with potential for a reliable, consistent, clean fuel. But regardless, it's not going to be a one-winner approach, right? The race for these data center developers is to develop data centers quickly and efficiently with continuous supply. That's going to require hybrid solutions using a combination of these technologies and technologies we haven't yet invented.
Great. And I think what that means is you sort of bring it all to a circle. These technologies are being developed by entrepreneurs at these technology companies that they look like what we think of as venture-backed companies, but they are getting into an industry that is very, very different than what we think of when we think of venture capital. And as a result, I think being able to couple the funds that we've seen traditionally in the energy industry with the entrepreneurs and their ideas will really help grow and help the technologies in the nuclear space, in the geothermal space, in all of these spaces thrive and allow these entrepreneurs to really build their companies and plug into the supply chain in a way that maybe they couldn't do that before.
Completely agree. And with that, I think our podcast is to end. Thank you, Scott.
Thanks, James.